Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so our market closed on a high today, guys, but hasn't really been able to push through the next level of resistance. Okay, so we got a nice big bullish day today. We followed leads from the US, which also looked a little bit more similar to this, but we can see we're up to that next level of resistance here. Spot on 74.85. We played with that today and pulled back a little bit, not a lot. So we've held strength today, which is a fairly positive sign. All my short-term indicators, though, guys, are looking way overbought. Okay, so there's without a doubt this market is overbought, and I do feel it's going to find a top very, very soon in the short term. So it's just a matter of time, whether it be this level here or whether it be one of the next few levels of resistance at either 70, sort of 75, 50, or 76, which is, around 76.25 is the all-time high. Uh, it's got to be holding one of those levels. We're talking at least what 10% from the lows here now. Not 10% on the S&P 500. It's more like 7.5 for us. Okay, but that's a very big move in a very short period of time. It's a bit of a relief rally for various reasons, and we'll talk to those reasons in a moment. But technically, guys, look, overall, we're still in a channel. Okay, we had the longer term trend through here that broke down. We had a little bit of a lower peak, lower trough scenario starting to play through. We've broken that downward momentum back into an upward momentum, but we're still challenging the thought of whether we're just going to channel here for the rest of the year or whether we're going to eventually break into an all-time high. Time will tell. There's too much going on to really predict that at this point of time. What I will say, though, is right now the market's a bit overbought. They are overdue a breather. When I say breather, it might be a small pullback, 100 points or something like that, or a period of sideways or sort of bit of consolidation. And that is common for our market after a big move. It's a bit of 2 weeks of sideways, a small pullback, and then for it to continue. Something like that, I think, is on the table here. If I come across the S&P 500, look, it's very similar. Big move, about 10% off the base there to where it sits right now. Okay, so yep, spot on 10%. It is approaching its next key level of resistance at 4,600. My gut feel says that's it for now. We're probably going to test that 46 and then either pull back, like I said, or go sideways. That's just the gut feel for the short term. But let's just see, right? Everything's overbought. It's going to come down to news flow. If we hear a bit of negative news, we'll get a pretty reasonable little pullback. If we don't hear anything negative, I think the steam should run out soon out of this bullish move in the short term. So that's where I'm at the moment, technically, guys. Let's talk about what's happening out there. Alrighty, so first things first to talk about tonight, we're going to see the Australian federal government, federal budget, I should say. At this point of time, that's been talked about in a very positive manner with some potential risks involved around inflation. So basically, it's a bit of a spending budget once again. Okay, obviously there's an election coming up. We should actually hear an election announcement by some point next week for the end of May. Right, so there's an election coming, guys. This budget's going to be a lot of spending, maybe some tax cuts, fuel excise being dropped temporarily, all of that, right? It sounds fairly positive for markets. Okay, it's more money being splashed around. The markets love that. Okay, that's one of the reasons why the markets rebounded so quickly after the COVID pullback. So look, the federal budget is, I feel at this point of time, seen as a little bit of a positive. Not a huge positive, just a little bit of a positive for the Australian market. Okay, and it could help us stay buoyant for a little bit here. As if Liberal stays in, though. If the Libs don't stay in, if Labor gets in, they're going to change the direction of that budget pretty quickly anyway, right? So it's very mixed for the mood of the market over the coming weeks and months of this election and what's going to play out there. Look, the big thing for me right now is keeping an eye on energy prices, right? So keep an eye on that crude price. One of the reasons why the market was able to rebound last night in the US was the fact that crude pulled back 10%. I think that really helped the mood of the market. If you got to remember, and one of the reasons why we had so much volatility on the back of the Ukraine and Russia crisis was the fear that crude was going to go to 180 US a barrel. That's a huge move, guys. Okay, and that was going to put a huge amount of pressure on inflation. It hasn't eventuated as yet. Instead, what we're now seeing is a bit of a range-bound crude price, and we're hanging just around that 100. We can't quite get past that 115 again. We've pulled back near 100. It's just not happening, right? And the market mood on inflation will ease on the back of that. So we've got to keep an eye on the price of oil, right? Because if the price of oil goes up, most things will go up because everybody's costs go up. Okay. On top of that, we've seen big movements in agricultural pricing. We've seen big movements in metals and mining and things like that. So all of that adds to the inflation story. But crude is the biggest cause of inflation, I believe. Okay, because it hits every market. It hits every consumer in one way or the other. All right. So energy prices are key at the moment, and that comes back to what interest rates are likely to do next. So obviously, we heard from the Fed a few weeks ago. The market's been rising ever since. The Fed has indicated that they're basically going to raise rates at every single meeting this year. They'll probably get themselves up to above 2%. Okay, that's the indication at the moment. That could change very quickly depending on what inflation does. Okay, so it's really tied to each other at this point of time. The Fed's committed to very quickly raising rates to battle inflation. And we'll see how that eventuates over the rest of this year. The RBA, though, we're still a little bit clueless here, right? So next week, Tuesday, is very important. We'll hear from the RBA again, and we'll see whether they actually start lifting or start indicating when they're going to lift rates. A lot of people have predicted they will start lifting soon. There's a lot of chatter out there now that if the libs do release this budget and spend a bunch of money, then the RBA may have to raise rates quicker than first thought. It's going to be interesting, guys. All right. Interest rates in Australia behave a little bit differently to in the US. You got to remember that if the RBA increases the rates here, all of our variable rate loans will go up. Okay. We're only able to fix for around 4 years. Okay, 1 to 4 is the common amount of time of fixing. In the US, people fix for 15 to 30 years, right? So you can actually fix your loan in for a very long period of time in the US. So lifting rates to 2.5% will have a different effect in the US than what it will have here. Okay, so that's just something you got to keep in mind. The RBA will hesitate in this environment. The housing market has become a bit overheated, and if they raise rates too quickly too soon, they will decimate the economy. Okay, so I do expect the RBA to lift rates. I don't expect them to be as aggressive as the US. All right, all this talk of interest rates rising is affecting the yield curve in some interesting ways. For the first time in a little while, and I think it's probably been a few years, we're starting to see the yield curve invert. The third year is now higher than the 10-year yields. Okay, that is a warning sign of recession. All right, so we've got to keep an eye on that space. What that says to me is interest rates going up, bullish equities. Okay, that's the general rule. People move out of bonds, come into equities in that environment. So what I feel is going to happen here is that very quickly the interest rate rises will peak. You got to remember most of the reason why interest rates are going up is because of inflation. Most of the inflation is being caused by supply chain issues. Yes, there's good demand out there, but if the supply chain was not interrupted by COVID and not interrupted by the whole Russia-Ukraine situation, the situation wouldn't be perceived as bad as what it is right now. So if you fix the supply chain problem, the inflation problem goes away and interest rates won't need to go up as aggressively. So I think a lot of people are expecting that to happen still, but it might take a year or two for that to happen. If interest rates peak and they go, okay, that's it, we're going to stop raising interest rates, money will flow back away from equities into bonds again. But I think once again, that's still a while away. I would be medium to short term bullish markets, guys. Okay, medium to bullish, uh, short to medium term bullish equities. Okay, at the moment in the current situation, with the caveat that if whole Russia-Ukraine situation gets worse, if that escalates and crude jumps, okay, if crude gets above 120 or 125, I think we've got a problem. All right. So given everything that we know right now, if things don't escalate further in Russia and Ukraine, with Russia and Ukraine, uh, then I think things could easily settle here. Markets can creep higher. Okay. If it escalates, if crude starts running again, that's when I get worried. So eyes on that energy price, guys. Every single day, you're going to be watching crude and what's happening in that space. The signals we're seeing in the yield curve are longer term signals. They will play out in years to come. The crude, the movement in inflation, CPI readings, comments from the RBA, comments from the Fed, that's all short term related, and the market's going to knee jerk around in that information. So we've got to keep an eye on that information as it hits, but also keep one eye on when we think the whole interest rates rising is peaked. Because once we think it's peaked, then you've got to start looking at reducing your exposure to equities. Okay. But for now, I'll be cautiously staying long, okay, with the view that we're going to pull back soon, right? Need a breather. So the next pullback's a good buying opportunity is what I'm trying to say here, guys, right? If we see our market come off a couple of 100 points and then we get some bullish signals again, I won't hesitate to go long, right? Um, but I'll also be keeping a very close eye on this whole crude oil Russia-Ukraine situation, all right? That's the key thing for me in the short term. All right, I hope I've brushed through most things. There's a fair bit still going on out there, guys. Okay, the nervousness has come off the market for the moment and just looking for signs whether that's going to come back on or not. But I believe the relief rally we've seen at the moment should come to an end, take a pause, and then continue. That's the current view. All right. Okay, take care, guys. Thanks for listening in, and bye for now.